In the first part of this two-part interest rate stresses criteria explainer, we outlined the criteria scope, summarized the underlying framework and applicable principles, and illustrated the construction of positive interest rate stresses. In the second part, we will dive into the construction of negative rate stresses and discuss basis risks and other special topics. As was the case in part 1 for positive rate stresses, the table shown here is part of the output the web user interface produces. Negative rates have historically fluctuated in narrow bands, and Fitch expects this to remain true in the future. One reason for this is that negative rates are only effective up to a certain absolute level, beyond which holding cash would, for a critical mass of agents, be economically preferable to maintaining reserves with the central or commercial banks. One of the criteria's simplified assumptions is that this so-called effective lower bound is a uniform minus 0.9% across currencies. Given negative rates' bounded nature, distinction between stress severities is achieved not by varying plateau levels, but by imposing a longer stress duration at the higher rating levels. This is 120 months at the AAA rating stress level and 48 months at the single B level. Similarly to stress plateau levels, stress durations for all other rating levels are interpolated linearly between the AAA and single B anchor levels. As the table shows, the stress parameters are uniform across currencies. In addition to the AAA and single B durations, these include the down baseline level, the multiple of spot rate, and long-term floor. We will illustrate the application on the next slide. Please note that we have not included the equilibrium rates, as negative rate stresses only depend on the starting spot rate, and the stress parameters discussed here and in the following slide. Those currency bases for which Fitch does not currently assume negative rates stresses are labeled NA in the negative parameter columns. These are typically jurisdictions which do not have a track record of negative rates and for which Fitch does not deem this sufficiently likely to change. This table is taken from the criteria and shows how the all-in stress durations of 120 months at the AAA and 48 months at the single B level are decomposed into transition and plateau times. We will illustrate this on the next slide. We are picking up the example of the US dollar with SOFR at 3.8%. If negative rate stresses are chosen in the model user interface, the positive downward stresses are replaced by negative rate stresses. In this example, the negative plateau is given by the down baseline level of minus 65 basis points, as shown in the table below the chart. The table was reproduced from the previous slide and shows all currency-independent stress parameters. At the end of the stress period, the rate reverses to the long-term floor of 0%. This is labeled reversion level in the chart. The rate does not return to the starting value of 3.8% or any other value than the long-term floor of 0. If the starting spot rate is already in negative territory, then the stress severity can exceed the minus 65 basis points given by the down baseline level. For instance, before the post-COVID rate hikes, Eurozone short rate, as measured by ESTA, hovered around minus 50 basis points for an extended period of time. If the starting spot is already negative, then the negative rates plateau, here labeled negative interest rate level, is given by the lower of minus 65 basis points and the multiple of spot rate times the negative starting spot rate. In this case, starting spot rate times 1.5 equals minus 75 basis points, which is lower than the baseline level of minus 65 basis points. The negative interest rate level is thus minus 75 basis points. Before the 2022 start of the latest monetary tightening cycle, the Swiss overnight rate fluctuated around minus 70 basis points. Applying the 1.5 rule, this would give a negative interest rate level of minus 105 basis points. However, the criteria is flooring the negative plateau at minus 90 basis points. The minus 90 basis points represent the effective lower bound mentioned at the beginning of the presentation. As illustrated earlier, the position of the spot rate in relation to the equilibrium rate can impact the level of the applicable plateau, i.e. the high or low watermark at the given rating stress level. If the starting spot is above the equilibrium rate, then the upwards plateau moves up in proportion to this distance. In the criteria table shown here, this proportion is quoted as progression factor. In our US dollar example, the SOFR spot rate of 3.8% exceeded the equilibrium rate of 3% by 80 basis points. Given the progression factor of 0.7, the default up plateau of 10% is raised by 80 basis points times 0.7, which equals 56 basis points. The applicable up plateau is hence 10.56%. Please note the progression factor of 0.95 for the single B rating stress level, which is higher than the progression factor of 0.7 for the AAA level. This reflects the fact that single B stresses are closer to the base case than the more remote AAA stresses and have thus to be more responsive to the starting spot in order to preserve stress characteristics. Conversely, if the starting spot rate is below the equilibrium rate, then the downward plateau moves down proportionally. However, given the zero bound in the positive rates world, the rate compression is modeled as an exponential rather than a straight product. Please consult the criteria for details. Given positive down plateaus are already relatively close to zero, no distinction is made between rating levels in terms of progression factors for the low rate stresses. As explained earlier, the criteria capture the reset risk that can arise when underlying pool contracts or nodes and money stores such as cash accounts are pegged to a given reference rate. The dynamic interplay of these rate-sensitive deal components can expose the deal to rising or falling rates at different points in time. Cash flow modeling will reveal these dynamic vulnerabilities. If more than one reference rate is involved, then matters become a bit more complicated. If the reference rates display equivalent risk characteristics, then the inherent basis risk might not be material, and the rating committee might decide not to distinguish between reference rates for the purpose of cash flow modeling. However, if the risk of the reference rates diverging in a stressed macro environment is deemed material, then basis risk will have to be accounted for. This is typically done on a sector-by-sector basis, which enables us to analyze basis risk in the context of a given sector. It is also a reflection of the fact that basis risks are often sector-specific, and overlap with other sector-specific criteria is limited. As a result, the cross-sector criteria do not provide quantitative guidance, instead referring to sector criteria and Appendix 3 to the criteria, which lists the basis risks considered in all relevant sector criteria at the time of replication. The UK RMBS example shown here is typical in that haircuts to margins are assumed to provide a buffer against the risk of material divergence. We've just seen an example of how sector criteria can complement the interest rate stresses cross-sector criteria in terms of dealing with specific risk components, such as sector-specific basis risks. More generally, sector criteria take precedence when specific sector requirements make carve-outs from the cross-sector criteria necessary. Let's take a look at two salient examples. In the structured credit space, where asset coupons are typically floored at zero, the impact of negative rates might not be material. The analytical group therefore applies the standard in brackets positive interest rate downward stresses in their CLO rating analysis. Turning back to the RMBS space, if note interest is capped, then our standard remote upward stress scenarios will, everything else equal, benefit the transaction, provided the mortgage pool is floating. In this case, a lower upwards plateau level will be the more stressful one. If interest rate resets are not smoothly distributed over time, or if they are clustered, then the criteria's premise of a smooth stress ramp-up might not adequately capture a given deal's rates exposure. In such a case, the criteria are mandating the analytic groups to design bespoke stresses featuring the required specific sensitivity. Fitch has developed Chinese interest rate stresses to analyze the interest rate risk in securitization transactions where both the notes and underlying assets are indexed to either the 1-year or the 5-year loan prime rate. Given the political nature of Chinese interest rates, the upward plateau levels for Chinese interest rate stresses are based mostly on Fitch's interest rate expectations over a 2-year term, rather than on observed historical indexes. Please consult the criteria report for details.